Jane Street's tech-driven approach to market making is rapidly redefining the landscape of Wall Street. But the journey has been far from smooth. Recently, the firm found itself in a tense confrontation with the Securities and Exchange Board of India. And although this regulatory battle remains unresolved, Jane Street has still managed to deliver eye-popping financial results for the second quarter of 2025. The headline? Their earnings were nothing short of extraordinary. Just yesterday, an Indian appeals court ordered the Securities Appellate Tribunal. This development keeps the dispute very much in the spotlight, and it raises important questions about transparency and fairness in regulatory processes. Turning to the numbers, Jane Street's second quarter of 2025 was historic. They reported an astounding $10.1 billion in net trading revenue, setting a new standard on Wall Street for market-making firms. This is particularly noteworthy, given that 2025 has been a fruitful year for investment banks overall. But Jane Street has surpassed even these strong performances by a significant margin. To put things into perspective, J.P. Morgan, one of the industry's giants, recorded $8.9 billion in markets revenue in the same quarter, while Citi reported $5.879 billion. Jane Street's figure doesn't just top these. It signals a seismic shift in market power away from traditional banks towards technology-focused trading firms. Bloomberg's recent coverage of leading Wall Street firms' market revenues clearly illustrates this trend. However, not all sentiment surrounding Jane Street is glowing. Fitch Ratings, a global credit rating agency, recently reviewed the company's financial health and affirmed their credit rating at BB+. While this rating recognizes some level of durability thanks to risk management strategies, Fitch also pointed out the significant uncertainties tied to regulatory challenges in India. They warned that increased scrutiny from global regulators, sparked by this dispute, could restrict Jane Street's growth opportunities and pose a serious risk to their future expansion. Several factors contribute to this cautious outlook. Beyond the ongoing issues with Indian regulators, there is concern about the pace of capital growth relative to the company's expanding balance sheet. Specifically, Fitch highlighted that if Jane Street's adjusted net leverage, an indicator of risk tied to debt, were to climb above 10 times assets, down from 5.4 times in the first quarter of 2025, the firm's credit rating could be downgraded. This leverage ratio is a critical measure, as too much leverage could expose the company to financial instability. Yet there are reasons for optimism. Should Jane Street successfully resolve the Indian regulatory dispute, it would remove one of the biggest clouds hanging over the company's prospects. Moreover, if their balance sheet leverage remains steady or decreases, Fitch's concerns might be alleviated, further solidifying the firm's standing in the market. But Jane Street isn't the only player shaking up the market-making world. Citadel Securities and Hudson River Trading are also fiercely competing for dominance in this space, and their strategies are just as fascinating. According to Bloomberg, Citadel Securities experienced an 8.4% decline in trading revenue during the second quarter compared to the previous quarter, which sparked the firm to increase their spending on employee compensation and benefits. The expenditure on personnel rose from $1.55 billion in the first half of 2024 to an impressive $1.81 billion in the same period of 2025. Despite the revenue dip, the first 6 months of 2025 have been Citadel's best ever, generating a remarkable $5.77 billion in revenue. On another front, Hudson River Trading more than doubled its net trading revenue year over year for the second quarter of 2025, reporting $2.62 billion compared to $1.29 billion during the same period in 2024. This surge can be largely attributed to increased trading volumes, fueled by market volatility stemming from factors like the trade tariffs imposed by former President Trump. These conditions have created fertile ground for high-frequency trading firms to capitalize on rapid fluctuations. Looking ahead, we may soon witness Jane Street, Citadel Securities, and Hudson River Trading becoming household names, a status historically reserved for the so-called global systemically important banks. G-SIBs like JP Morgan and Citi. The traditional dominance of these banking giants is increasingly challenged by these tech-savvy market makers, and it wouldn't be surprising to see new entrants further disrupt this evolving landscape. Here's where it gets controversial. Should regulators around the world clamp down harder on firms like Jane Street due to their aggressive growth and opaque trading strategies? Or is this simply the natural evolution of financial markets embracing technological innovation? And how will the balance between regulation and innovation shape the future of market making? What do you think? Is Jane Street's rise a healthy sign of progress, or does it highlight risks that regulators have yet to fully grasp? Share your thoughts below. Should firms like Jane Street be welcomed as pioneers or approached with caution due to potential systemic risks? Author Andy Samu.